Returned from Dubai or the UAE, and suddenly your bank is deducting 20% TCS on overseas transfers? Here's why. Welcome to this explainer. Today, we are breaking down a massive financial trap that catches countless returning expats completely off guard.
Okay, let's just dive right into this. You see, if you were an NRI, you generally didn't use the Liberalized Remittance Scheme. You basically had the freedom to move your foreign earnings around without really worrying about Indian capital controls. But the moment you become a resident Indian, the LRS applies to you.
And here's the bigger surprise. For many remittances above 10 lakh rupees, the bank may actually collect a 20% TCS upfront. Let me put that into perspective. Suppose you want to send 25 lakh rupees abroad, maybe to invest in US stocks or just to support a family member. If that remittance falls under the 20% category, the bank could collect a whopping 3 lakh rupees as TCS right then and there.
So your account may be debited 28 lakh rupees, even though only 25 lakh rupees is transferred overseas. No way, right? This is exactly why many returning NRIs experience a sudden, massive cash flow shock. It feels like a penalty, and honestly, it completely disrupts your financial planning. But to fix this, we really need to understand why it's happening in the first place.
Section 1. The Great Status Flip. FEMA versus income tax residency. Notice the stark contrast here. When you return to India, your residency status under the Income Tax Act changes pretty slowly. In fact, you might even get a transitional resident but not ordinarily resident or RNOR status for up to 3 years, which actually shields your foreign income. But under the Foreign Exchange Management Act, or FEMA, the change is instant. The exact day your plane lands with the intention to settle, your FEMA status flips immediately to resident. And because your FEMA status changes instantly, well, your banking must change instantly too. You simply can't operate with an NRI mindset anymore. Your non-resident accounts, like your NRE accounts, must be redesignated to resident accounts. Those unlimited repatriation privileges you used to have, suddenly lost. And most importantly, your outbound capital is now completely locked into the domestic regulatory framework. Section 2. Welcome to the LRS, the new rules of repatriation. The absolutely crucial point here is understanding the new gatekeeper of your foreign transfers. The Liberalised Remittance Scheme is the Reserve Bank of India's official framework that allows residents to send money overseas. Whether you are paying for education, investing in foreign stocks, traveling, or just sending gifts, the LRS is the legal route you now have to take. That means overseas remittances are now subject to a USD $250,000 annual limit. Every single financial year from April to March, this is your absolute ceiling across all banks combined. As an NRI, you literally never had to worry about this limit, but now, every dollar, pound, or dirham you send out of India ticks away at this quota. Section 3. How the TCS works. The 20% reality. So the government uses TCS to track high-value outflows. Notice the big difference in rates here. If you are sending money for education that's funded by a specific loan, there is 0 TCS, nil. For self-funded education, medical treatment, or overseas tours, the rate is a pretty manageable 2% above a 10 lakh threshold. But look at the bottom row. For investments, property purchases, or family maintenance abroad, which, let's be honest, is what most returning expats are actually doing, the rate is a steep 20% the moment you cross that 10 lakh mark. Let's break down the math on our earlier 25,000 rupees transfers so you can see exactly how the bank calculates this. The first 10 lakh rupees of your combined LRS transfers in a financial year, that's your tax-free threshold. That leaves a taxable base of 15 lakh rupees. Apply the 20% rate to that specific 15 lakh rupees, and boom, there is your 3 lakh rupee TCS hit. It's a really simple calculation, but a totally devastating one for your immediate cash flow. Section 4. The good news. TCS is not a penalty. Okay, take a deep breath, because the good news is that 3 lakh rupees is generally not an extra tax. It actually becomes a tax credit that can be adjusted or refunded when you file your income tax return. Think of it as an advance prepayment to the government that is directly linked to your PAN card. If your final tax liability in India is low, which it very often is for returning expats who have that RINR status we talked about, you do get this money back. So how do you actually reclaim your cash? It's a very structured process. First, always verify that the bank has reported the TCS in your Form 26AS or Annual Information Statement. Second, make sure you file the correct return, usually ITR2 or ITR3, definitely not ITR1.
Third, claim the credit under Section 206C(1)(g) in the Taxes Paid section. And finally, double-check that your bank account is pre-validated on the tax portal so the government can directly credit your refund. It might take a few weeks or months after filing for sure, but the money does come back.
Section 5. Your Repatriation Playbook. Managing Foreign Capital Smartly.
Timing is literally everything here. If you have large foreign commitments, like a child's overseas university fees, international insurance premiums, or offshore investments, you want to fund them before you return to India. Do it while you still have your NRI status and your offshore accounts are totally free from LRS rules. Because once you land, your status flips. Post-return, your number one priority is compliance. Redesignate your accounts immediately so you don't fall foul of banking regulations.
Now, you might be wondering, what if you have significant foreign currency savings that you just don't want to convert to Indian rupees right away? Well, there is a brilliant, highly specific tool designed just for you, the Resident Foreign Currency, or RFC, account. This is basically a bridge tool that lets you bring your overseas savings into an Indian bank, but keep them in dollars, pounds, or whatever the original currency is.
Why is the RFC account such a game changer? You can fund it directly from your old NRE or FCNR balances. That protects you from sudden currency conversion losses on the day you land. Plus, if you secure that RNOR tax status we mentioned earlier, the interest you earn on this account is completely tax-exempt in India for up to 3 years. And best of all, if you decide to move abroad again, these balances are freely remittable without needing fresh regulatory clearance. It is literally the ultimate flex tool for a returning expat.
We've covered a lot of ground today. The absolute key takeaway is that you have to plan large remittances after properly understanding your residential status, the LRS limits, and these TCS implications. Don't let taxes and compliance be an afterthought. Proper relocation planning is really the only way to avoid that visceral return shock. Returning to India changes the rules. You've worked incredibly hard for your wealth abroad. Don't let a lack of planning tie it up in advanced tax collections. Plan your overseas remittances before the 20% TCS catches you by surprise. Are you ready to map out your financial transition? Thanks for joining me on this explainer, and I'll catch you in the next one.